We are looking at Beyond Meat, NASDAQ ticker BYND, and the stock is currently trading live at $1.06. That is a drop of about 1.85% just this morning as the market digests what exactly is happening with this company. The stock opened at $1.12, hit a high of $1.13, but has since fallen to a low of $1.02 and is now trying to find some kind of support at this 106 level. Now, most people watching this price tick by see a stock that has fallen from grace, a former high flyer now in penny stock territory. They are watching the Q3 earnings, they are watching the analyst downgrades, and they are assuming this is just a simple story of a company failing. But what if the reality of the market mechanics is far more complex? What if I told you that while the public was focused on last week's earnings report, an absolutely stunning anomaly was happening in the background? In mid-October, the most recent data available shows that over 37.9 million shares of Beyond Meat failed to deliver. That is not a typo, 37 million shares. That is a number so large it dwarfs the stock's average daily volume, and it points to a severe settlement and liquidity problem that almost no one is talking about. This isn't just a story about vegan burgers anymore. This is a story about market structure, extreme bearish sentiment, and a company that is now fighting for its very survival. Let's establish what everyone believes. The common expectation for Beyond Meat, for years, was that it was the future. It was a clean, ESG-friendly, high-growth food tech company that was going to capture the hearts, minds, and dollars of a new generation. Investors bought into a narrative of exponential growth, endless restaurant partnerships, and a world where plant-based meat wasn't the alternative, but the standard. That was the expectation. The reality, as reflected by this $1 stock price, is a brutal counter-narrative. The reality is that demand has not just softened, it appears to be collapsing. We have to talk about the Q3 2025 earnings that were dropped on November 10th. This is the catalyst for the most recent leg down. The company reported revenues of $70.2 million. Now, on the surface, that actually beat the analyst estimate of about $68 million. But this is a perfect example of how Wall Street plays the expectation game. The real number, the one that matters, is that revenue was down 13.3% year over year. Sales are shrinking. Worse, the company's guidance for the fourth quarter was catastrophic. Analysts wanted to see $71 million for the upcoming quarter. Beyond Meat came out and guided for just $62.5 million. That is not a miss. That is a warning signal. It tells us that management has zero visibility or confidence that sales will rebound anytime soon. Then, buried in that report was the number that truly defines the company's predicament, a $77.4 million non-cash impairment charge. When a company takes an impairment charge, it is the accounting equivalent of admitting defeat. It is management formally stating that the stuff they own, factories, equipment, assets, is not worth what they previously claimed it was worth. They have essentially written off a massive chunk of their past investments. This is the reality that shatters the growth stock expectation. You cannot be a growth stock when your sales are shrinking and you are telling investors your own assets are worth less. This is why we are at $1.06. The market is processing this information. The day after the earnings, the stock plummeted. And just a few days ago, on November 13th, Misuzu, a prominent analyst firm, came out and slashed its price target from $1.50 all the way down to $1. The stock is now trading directly in line with that new, bleak target. The market is agreeing with the most bearish analysts. The consensus on Wall Street is now a firm sell. This brings us to the short-selling activity, because with a story this negative, you know the shorts are heavily involved. Right now, the latest data shows about 65 million shares are being held short. As a percentage of the public float, that comes out to 14.77%. Now, 14% is a significantly bearish number. It shows a high degree of conviction from institutional players that this stock is going lower. The short thesis is simple. The company is burning cash at an alarming rate, it has a massive debt load, and its core sales are in freefall. They are betting that the company cannot cut costs fast enough to offset the revenue collapse. Now, I know what many retail investors are thinking. 14% short interest? That's high. Can we squeeze them? This is where we need to be analytical and look at the data, not just the headlines. When you want to see if a stock is a good short squeeze candidate, you have to look at the days to cover and the borrow fee. The days to cover tells you how long it would take for all shorts to buy back their shares. Based on average volume, for Beyond Meat, the days to cover is only 0.75. That is incredibly low. It means that shorts could cover their entire position in less than one trading day. There is no panic, there is no rush. They are not trapped. Second, we look at the cost to borrow the shares. If a stock is hard to borrow, the fee rate will be high, putting pressure on shorts. The borrow fee for Beyond Meat is currently around 2.7%. That is not high at all. It is cheap and easy to short this stock, which means the shorts are comfortable. They are not feeling any pressure to cover. So, what's your take on that 14.77% short interest? Is it smart money betting on the inevitable, or is it overhyped? Let's circle back to that truly bizarre 37.9 million fails to deliver number from October. Fails to deliver, or FTDs, occur when one party in a trade fails to deliver the shares on the settlement date. The SEC is quick to point out that this can happen for many reasons and is not by itself proof of naked short selling. However, the sheer scale of this number is what is so staggering. A few thousand FTDs is normal. Millions is a red flag. Tens of millions on a stock with this low of a price is a massive signal of dysfunction. It suggests that for a period of time, a huge number of shares that were being traded simply did not exist or could not be located for settlement. This is the kind of data that lights up forums on Reddit and X, with investors claiming it is a sign of deep, coordinated manipulation. The reality is that it is a sign of extreme stress in the system. It is a sign that the plumbing of the market for BYND is under strain, and it adds a layer of volatility and unpredictability that most investors are not prepared for. So, how do investors navigate this? If you're a long-term investor, you have to find data that counters this bearish thesis. You would look to the small bits of good news the company is trying to push. They recently announced a new partnership with Hard Rock Cafe. They are rolling out new value packs in Canada. They are getting their products into high-end grocers like Erewhon. This is the company's business model at work. Get products in front of consumers. But the $1 price tells you the market believes these small-scale partnerships are like trying to plug a sinking ship with a cork. They are not enough to offset the core decline. The bull case, if you can even call it that, rests entirely on what CEO Ethan Brown highlighted in the earnings call. It is not about growth. It is about survival. He pointed out that the company has successfully restructured its debt, exchanging its 2027 notes and extending its maturity. This buys them time. They are adding liquidity to the balance sheet. The entire bull case now is a cost-cutting and balance sheet management story. They are trying to shrink the company to a size where it can be sustainable, or at least survive long enough for a potential acquisition. The expectation of a global food brand is dead. The new reality is a company in triage, trying to stop the bleeding. For retail investors, it is crucial to understand what you are looking at. This is no longer a buy-the-dip situation on a high-growth stock. This is a falling knife on a distressed asset. When you see a stock with a 14% short interest, a low borrow fee, a low days to cover, and a history of massive fails to deliver, you are not in a safe investing environment. You are in a speculative trading vehicle. The risk is exceptionally high. When you see discussions on social media about squeezing this, you must look at the data for yourself. You can find short interest data on Fintel or Ortex. You can find the fails to deliver data straight from the SEC's website. It is public, but it is delayed by a few weeks. What you will find is that the data does not support the squeeze narrative, but it does support the high-risk narrative. Looking forward, the path for Beyond Meat is incredibly narrow. The company has to hope that its cost-cutting measures are deep enough to reach profitability before its cash reserves are depleted. It has to hope that the category headwinds are temporary and not a permanent consumer shift away from high-priced processed plant-based meat. And it has to hope that it can manage its debt without having to dilute shareholders into oblivion by issuing more stock, which at $1 would be almost pointless. The $77 million impairment charge is a signal to the market that the past is over. The growth story is done. The only question now is what, if anything, can be salvaged. Drop a comment below. Do you think Beyond Meat will even be a publicly traded company in 2 years, or will it be acquired for pennies or go bankrupt? In summary, the expectation that Beyond Meat was a revolutionary food company has collided with the harsh reality on its financials. The company is not growing, it is shrinking. It is not profitable, it is burning cash and writing off assets. The $1.06 price is the market's cold, hard assessment of this new reality. The high short interest is not trapped, it is comfortable. And the anomalous fails to deliver data suggests a level of market structure stress that should make any investor cautious. This is a story of a great idea and a compelling narrative that simply failed to translate into a sustainable business.